What we basically do is using the knowledge we learned from chapter 5 and apply it in different contexts, right? So for in bond, it's a fixed income security, which means it has a maturity, it has a equal periodic payments, and at the very end, just when it matures, we have just one-time principal payment, right? What we do is we discount it to a present value, okay? That's what we do for bond valuation. But stock is a little more complicated. First of all, it doesn't have a maturity. It doesn't have maturity. And the periodic payment, what we call is the dividend, right? Dividend is not necessarily being equal. It could change. As investor, we hope the dividend could be increasing year by year, right? And what's more, it doesn't have a principal, right? Does the stock has a principal payment that some years later? No, it doesn't have, right? But we're going to have models to price stocks. But the basic line is we're using time value of money techniques to solve those things, right, to get the prices of that. So let's get started for chapter 6. So for bond valuation, I assume you have known the basic knowledge about bond. What is a bond? And how it is compounded, the compounding frequency, right? So let's get started with two, I think, very important graphs. The first one is the relationship between the bond price and the yield to maturity. So what is yield to maturity? Yeah, it's an annual interest, right? Which makes the the present value equal to the current price. To be more detailed, the present value of all the future cash flows from this bond equal to its current price. What is current price? The consensus of all the investors on the market, right? We have a consensus. We think this bond should be, the value of this bond should be equal to 900. So the yield to maturity for this bond is the interest rate that makes the present value of all future cash flows equal to this $900, right? Okay, so the bond price and yield to maturity. What should be the relationship between the two things?
Yield goes up, price goes down.
Yeah, and is it a straight line? It's a curve, right, exactly, it's a curve. So as the yield to maturity goes up, stock price goes down. So if you can think about it in this way, so yield to maturity is a return that an investor request for this bond. So if the return is higher, that means its current price should be lower so that it can provide a higher return, right? So at a certain level of yield to maturity, the bond price will be equal to its face value, usually 1,000. So the face value of most bonds are $1,000. So at a certain level, its price is going to be equal to the face value. So let me tell you the coupon rate. Yeah, there is 8%, for example. So what should be that level is? So 8%, right? So when the yield to maturity of a bond is equal to its coupon rate, the bond is sold at par value, right? Par value, good. So what if the yield to maturity is greater than 8%, let's say 9%? Its price is going to be higher or lower than 1,000? Lower than 1,000. So it's like right here, right? It's lower than 1,000. Go down a little bit. Let's say it's 900. So we call it, it is sold at discount, right? Discount. So let's move it the other way to 7%. It's going to go up, right? Premium, right, exactly, premium, $1,100. So a premium. So we know is if the yield to maturity of a bond is higher than the coupon rate, it's going to be sold at a discount. If it's lower than the coupon rate, it could be sold at a premium. Okay, that's the first graph. The second graph is, okay, so the horizontal axis is time to maturity. Time to maturity. And the vertical axis is still bond price. All right. Let's say we have 3 bonds with 3 and yield to maturity is the same. Yield to maturity, let's say, is 10%. Okay, and we have 3 bonds. Give you different coupon rates. One is 8%, one is 10%, one is 12%. And this is time to maturity. So let's say this is 10-year. So as we move to mature, we move along this line. We move in this direction. We move toward the maturity, right? So let's say for the 10% coupon bond, what would the price be? It's going to be equal to the yield to maturity, so it's going to be constantly be $1,000. So let's say this is 1,000. So it could always be 1,000, right? This is very simple. So coupon rate, let's say coupon rate 12, 8, and 10, okay? 12%, 8%. Okay. All right. 10 is pretty. It's flat. It's constant. What about a 12% coupon bond?
It'll start approaching 10% as it gets closer.
Yes, exactly. So it's coupon rate is higher than yield to maturity, so it's going to be sold at premium. So the original price should be higher than 1,000, but as it goes toward the maturity, its price gonna be dropping. It's going to be decreasing. At the very end, it's going to be $1,000 at maturity, right? But for the 8%, the coupon rate is lower than the yield to maturity, so should be sold at a discount. So it'll start at a discounted price, and then when we go toward the maturity, it's going to reach $1,000. So in this whole process, what we assume is yield to maturity stays at 10%. It doesn't change. Okay, it's always 10%. And this discount rate, yeah, we know it's never it never changes because it's predetermined in the contract, right? So these are the two graphs I want to show you. So we're going to use those graphs a lot when we are solving these questions, okay? So let's get started on the question 19. Bond yields. All right. So if a bond with a face value of 1,000, so most of bonds have face value of 1,000, right? Okay, face value 1,000 bonds and coupon rate 8%. 8% is selling at the price of $9.70. Is the bond's yield to maturity more or less than 8%?
More.
Why is it more?
So it is discounted.
Exactly. It should be more than the coupon rate, right? Because it's selling at discount, the yield to maturity should be greater than the coupon rate. Okay? Yeah.
Which was so Y before was on the y-axis when you had the bond price. You put y.
Bond price.
Yeah, right.
Yeah.
But you had the y-axis, the bond price, YTM that was above, that was approaching towards the x-axis. That was at a higher bond price. Wouldn't it be at a lower?
Yeah. Have a lower. Yeah.
Yeah.
Yeah. What is that is right. Right. Yeah. Yeah. Right. So it's correct. Yeah. Now it's the bond. Now it's sold at discount. So the coupon rate, okay? So the coupon rate is equivalent to like 8% in our previous example, right? 8% is lower than yield to maturity 10%. It's sold at discount, but when we approach the maturity, it's going to increase, and at maturity is 1,000. Okay? Yeah. That's question 19. 20. A bond with face value 1,000 has a current yield of 6%, the coupon rate 8%. Okay? So what is the formula for current yield? Current yield is what divided by what? Oh, sorry. Which one? This one? We're gonna upload this to Blackboard, so you don't actually need to take pictures. Yeah, you can have.
Because our exam is tomorrow at.
I'll try to upload it tonight. Okay, yeah. Face value 1,000, current yield 6%, and coupon rate 8%. So what was this formula for current yield?
Isn't it dividends over coupon by payment? Coupon by payment?
It's a coupon payment, right? Good. A coupon payment. What I want to add is annual coupon payment, right? That's very important. That's not one payment. It's a payment for the whole year. If you have more than one compounding frequency within a year, you have to add them up, okay? And divided by the bond price, exactly, bond price. Okay. Now we know how much is it? 6%. 0.06. And a coupon rate of 8%. So coupon rate of 8%, that means the annual coupon is how much? $80. So this is $80. Right. So how much of this price is? 80 divided by 0.06. Oh, sorry. Yeah, it's right here, right? So the annual coupon payment is $80. And current yield is annual coupon, $80 divided by the bond price. It is equal to 6%. So bond price should be equal to, so $80 divided by current yield, 6%, right? 1323.33. And B, is the bond's yield to maturity greater or smaller than 8%? It is smaller. Why is it smaller? Yeah, it is sold at a premium. So yield to maturity must be smaller than the coupon rate, right? Okay. It's pretty simple. 21. A general power bond carries a coupon rate of 8%, has 9 years until maturity, and sells at a yield to maturity of 7%. And assume an annual interest payment. So what interest payment do bondholders receive each year? Coupon rate 8%, $80, right? $8. At what price does the bond sell? We're going to use calculators, right? We're going to use calculators. So what are the variables that we know? It has 9 years to maturity, and yield to maturity is 7, and we know coupon payment per year is $80, and future value is principal amount is 100. Oh, sorry, 1,000. So we calculate for the present value. Okay, all right. Is it a premium at discount? Premium. So that premium, we're going to need that for, I think, D. Okay, let's take a look at C. So what will happen to the bond price if the yield to maturity falls to 6%? So it was 7% originally, and now it's 6%. Okay, 9 years, $80, and $1,000. So as the yield to maturity decreases, as we expect, the bond price should increase. Right? We see it does increases. What does the sign mean? Direction. Direction of cash flows, right? It doesn't carry an economic meaning, but we know it's an inflow, outflow thing, right? So the absolute number, the bond price actually increases. By how much? $70. Okay? And last one, if the yield to maturity falls to 6%, like what we said we see in question C, what will the current yield be less, more, or less or more than yield to maturity? We don't know. First, let's calculate for that. It's pretty simple to calculate current yield because we know annual coupon is $80. And when the yield to maturity is at 6%, the bond price is 1136.03, right? So this is the current yield, okay? Current yield is 7%, and yield to maturity is 6%. So yield to maturity is lower than the current yield, okay? This is less obvious. Let me tell you some bond facts. So if a bond is sold at a premium, the coupon rate should be greater than the current yield and greater than the yield to maturity. Okay, yield to maturity. We know this, right? We know bond rate and yield to maturity, the relationship between the two from the graph, right? We showed just now. And we don't know this. Okay, I'm not going to explain this in detail, but you can just memorize that. If a bond is sold at premium, both current terms, the coupon rate and the current yield, are greater than the yield to maturity. And if it's sold at a discount, okay, coupon rate is smaller than the current yield and smaller than the yield to maturity. Okay? If you're not sure about this, raise an example. In an example, if you're not sure about what the direction should be, give yourself some numbers and try it in your calculator. You're going to easily get the answer to this. Okay? Right. But in this case, current yield is 7%, it's greater than 6%. Okay? Good. Question? 22, bond yields. It has 8 years until maturity, has a coupon rate of 8%, and sells for $1,100. What is the current yield? Annual coupon divided by the bond price. Okay, 80 divided by 1100, 7%. Okay, so and what is the yield to maturity is, so B and C, see we changed the compounding frequency. For B, it is paid for once a year. It's annual compounding. The second one is paid semi-annually, so it's compounded twice a year. What is the yield to maturity? Basically, we are calculating for the IY. Okay, so you take a look at the first one. So if it's annual compounding, what DTS said, N is the number of periods. So it is N multiplied by M. N is number of years, M is the compounding frequency. Okay, if it's quarterly compounding, it's 4. It's monthly compounding, it's 12. The daily compounding is 365, right? Okay, so this number of periods, 8. Present value, bond price, is negative $1,100. Annual payment, not annual payments, the payment for each coupon is $80, and future value is face value 1,000. So we can get IY. But now let's change it to semi-annual compounding. Number of periods becomes 16. Great, 16. And present value is still bond price. And coupon payment, 40, right? So one coupon payment is annual coupon payment, which is 80, divided by the compounding frequency, which is 2. So 80 divided by 2, so 40. And face value is $1,000. We got IY. What that IY is? That IY is the yield to mature, is the yield for one period. We have 16 periods in total. That's for one period. But yield to maturity is an annual term. We're gonna need that. Multiply by 2. We multiply that 3.19% by 2 and 6.38%. Okay, good. Next one. A 6-year circular file bond pays interest once a year of $80, sells for, at a discount, $950. So what is the coupon rate? 8%. What is the yield to maturity? So is it annual compounding? It doesn't say, then we assume it is annual compounding. If it doesn't say, it doesn't tell us how it is compounded, it's annual compounding, right? All right, 6 years, and the present value, $950. Coupon payment for each payment is $80, and future value 1,000. Okay, and IY is 9%. Okay. All right. Question C. So if Circular wants to issue a new 6-year bond at face value, what coupon rate must the bond offer?
Yield to maturity.
Yield to maturity. It must be equal to the number that we calculated in question B. So we get the yield to maturity, we get the required return from the investors of this bond, and then move it backward. If we want the bond to be sold at par value, we should have a new bond with a coupon rate equal to this yield to maturity, which is 9%. Okay? All right. 24. Now this is not plain vanilla bond. Now it becomes a zero coupon bond. Okay, zero coupon bond doesn't have a coupon. We buy it right now, we wait it until maturity, and we get the principal payment of $1,000. Okay, so its pricing is much easier. We just need to discount that $1,000 at the maturity to our present value. Okay, so we have 3 zero coupon bonds. All right, and we have different unknown variables. The question is, what is the yield to maturity for bond A? See what variable we have. Maturity number of years, 30 years. And present value is the price negative 300. And PMT is 0. Okay, PMT 0. It'd be no coupon, right? 0 coupon. And future value is $1,000 coupon payment. We got the yield to maturity for bond A. And what is the maturity for B? Similar thing, right? So now we have a yield to maturity. We got the price. We got number of years. We got future value. And we got present value. So sorry, we don't have a number of years. We don't have number of years. It's only unknown variable. All right. Yield to maturity 8%. Present value negative 300, 0 and 1,000. Okay. Number of years 15 years. Okay. Yeah. And what is the price for C? Similar thing, right? Move it a little bit. So number of years, 10 years. Yield to maturity 10. And PMT 0, still 0. And face value 1,000. And calculate for the present value. OK? All right. Number 25. So SureCo has issued 9% annual coupon bonds that are now selling at a yield to maturity 10% and current yield, so 9.8375%. So what is the remaining maturity of these bonds? We need to calculate for n. Okay, so we need the other 4 variables. So number, so IY and PV, yeah, PMT, and future value, right? And then we calculate for n. See what we have. Coupon rate, 9%. We got this. It's 9%. So, and it's annual coupon, 90, right? 90, good. And now selling at a yield to maturity 10%. So IY is 10%. 10. And present value.
By 0.098.
Yes, we're going to use a formula for current yield. So current yield is equal to 9.8375. It is equal to annual coupon, 90, divided by bond price. Okay, so how much is that? $914.87. Okay, this is 914, and future value 1,000. Don't forget the sign. This is negative, okay, and 2 positive. And if you want to make it negative, be sure to put this positive, okay, and get a number of years. You may need to round it a little bit, but it's approximately 20, okay, 20 years to maturity. Are we good? Okay. 26. You buy 8% coupon, 10-year maturity bond for $980, and a year later, the bond price becomes to $1,200. Assume annual coupon payment. What is the new yield to maturity on the bond? Okay, and what is rate of return over the year? So what is the new yield to maturity? NIY present value, PMT, and future value. We need to calculate for this, right? Okay. Now we got N is how much? 10 years, and a year later, yeah, 9, right? It's 9. And present value is 1,200, and PMT 80, and 1,000. Okay. And calculate for IY. 9, negative 1,200, 80, 1,000. Yeah, 5%. So what is the rate, for the second one, what is your rate of return over the year? It asks you the holding period return. So you hold it for 1 year, you got some return. And that return has 2 parts, 2 components. First is the current yield. The return, the fraction of return that you get from the current income, which is coupon. The other is capital gain yield. The yield or the return that you get from the price appreciation. Okay, it could be positive, it could be negative, depending on how your bond price compared with the face value. So what is our holding period return? It's equal to annual coupon, which is $80, plus the capital gain. Let me write that down. It is the holding period return is equal to current income plus capital gain divided by the purchase price. Purchase price. The price when the price at the beginning of your holding period. In other words, this is your purchase price. And what is capital gain? It is the ending price or selling price minus the purchase price. Right, the capital gain. So the price of the asset, the increase of the price of the asset that you hold. Okay. So purchase price is how much? 980, right? 980. And the current income, you hold it for 1 year? $80. And the capital gain is the change in the price. So it is how much? 1,200 minus 980, right? Yes. Okay. I erase it right here. Okay. So holding period of 30% is amazingly high. Okay. All right. Next one, 27. This formula applies not only to bond, it applies to any financial asset. The return that you get from this current period has two parts. One comes from the current income. The other part comes from capital gains. So we're going to have another question about the stock that we show that this function also applies. Okay. Okay, 27. You have an 8% coupon and 20-year maturity bond, which when its yield to maturity is 9%. And 6 months later, the yield to maturity is 10%. So what is your return over the 6 months? Same thing. Your return over the 6 months is your holding period return. It comes from two parts, okay, the coupon and the capital gain. Okay, we're going to calculate it separately. First, we need to get the prices, the purchase price and selling price. Okay, so the purchase price, let's call that P0. So N and IY and present value and PMT and future value. Okay, let's call that P0, our purchase price. 20 years to maturity, so N is 20. Is it annual compounding? Semi-annual compounding. So N is 40, right? And the IY is 4.5, right? 9 divided by 2. And PMT is? Or,
PMT is 80. Well, 40.
yeah. It's too many different answers. 40, right? 40. There's the annual coupon, $80 divided by the compounding frequency 2. Coupon rate 8%, 80 divided by 2, it's 40. And future value 1,000. Okay? So quickly calculate for this 40, 4.5, coupon payment negative. We got the P0, 907.99. Okay, 970.99. Yes?
Should we expect questions of around this difficulty on any given finance exam throughout the department? Shouldn't be anything enormously more complicated than this, right?
I'm not sure, actually.
Okay.
I'm not sure. I can't answer this question.
Some instructors
Depend.
might want to put 1 or 2 challenging questions
Yeah.
to
Right.
really separate the students. You might find 1 or 2 challenging questions
Right.
on an average.
Okay.
Yeah, in a question paper of 40 questions, there'll be 1 or 2 really tough questions.
That's what he did in his previous semesters.
Oh, yeah.
Detail taught us.
That.
So,
Question.
yeah.
So
yeah.
about the final, it's gonna be a department final or
We don't know.
We don't know yet. Yeah.
We don't know that yet.
We don't know that yet. Yeah.
Got it.
Yeah. Okay. All right. So purchase price, we got the purchase price. What is our selling price? 6 months later. Now the variable changed a little bit. Okay, I'm not going to write it. So N becomes 39. 6 months, 1 period. 40 minus 1, 39, right? Okay. So IY becomes now yield to maturity 10%. So for each period, it's 5. IY becomes 5. And PMT is still 40. And the FV is still 1,000. And we calculate for P1. Okay. It's 829.82. Okay, so that's what you have. So purchase price and selling price. And what is our current payment, current income? 40, right? Just 1 period. Okay, the holding period, we got a holding period return. Where is it? Oh, so not this one, not this one. This one, okay? So 40. And selling price minus purchase price divided by purchase price. Holding period return is a negative 4.2%. Where that negative come from? We got a capital loss, right? Capital loss, depreciation, right? Okay. But the current yield is positive, okay? But the capital loss is even greater, right? All right.
Would the term be depreciation to describe the decrease in value of a holding period return of a bond?
Of a price of financial security.
For any security, though.
For any security, yeah,
Okay.
depreciation, yeah.
Depreciation is for assets.
Not assets, not only financial assets, basically all assets, right?
Really? Okay.
Yeah, basically all assets. Property, plants, equipment, all the fixed assets in your company's depreciation. Yeah, if you come from accounting major. Yes.
Why isn't it
39.
Why isn't it 34 instead of?
This is 39.
Yeah, but shouldn't it be 34?
Why is it 34? Okay, so we have 20 years and semi-annual compounding. So total number of years is 40. And 6 months later, 6 months is 1 period, right? And so 40 minus 1, right? Yeah. Okay. Good. 28. Okay, we got a 2-year maturity bond with face value 1,000. Makes annual coupon payment $80 is selling at the face value. What would be the rate of return on the bond if it yields a maturity at the end of the year is this and this and this? Okay. So what we got in here? So we have 3 variables exactly the same, right? So we got number of years the same. This is the only 1 year, the holding period return, right? It's only holding for 1 year. But the yield to maturity is different, 6, 8, and 10, okay? And coupon payment is the same, $80, okay? And face value the same, 1,000. So the only different variable is IY, okay? And then we got a holding period return. So 9%, 8%, and 6%, okay? All right. I think we got enough questions on holding period return, right? You got to be very clear about this. Okay. All right. So next one. Face value would be the real rate of return. So these two different questions. So this is the rate of return. We got the holding period return, which is monetary, which is by numbers, right? And now we got it a little different. The real rate of return. This term actually comes from the Econ 1002, right? From your macro class. Yeah, what is a function formula for real rate of return?
1 plus the real return equals.
Real return equals.
Well, it's 1. Yeah, 1 plus equals 1 plus the nominal over 1 plus the inflation. Divided by.
Divided by, right? Let me reformat it a little bit.
1 plus the real.
So 1 plus a nominal rate of return
Divided by.
equals 1 plus real rate of return multiplied by 1 plus inflation rate.
Right. That's
Yeah.
the same thing.
Good. All right. So what number do we have in here? We got all these. The nominal terms, yeah. And then inflation. What is it? So 4, 6, and 8, right? Holding period return in nominal terms is 7%. Okay, $70. It's sold at premium. So it's 7%, right? Suppose you have a blah, blah, blah with 7% paid annually if you buy the bond at face value. In nominal terms. 7%, nominal terms. Okay, right? Is it correct? Is it right? Yeah, so yield to maturity is 7%?
Yep, gives you
Because it's face value, right? It's face value. Yeah, right. Face value. So it stays that you buy it at 1,000. It stays at 1,000 during your holding period. So 1,000 minus 1,000, 7% holding period return. But it's nominal. We need to get the real rate of return. So the real rate of return is equal to this divided by that term and minus 1. Okay? Get the second one from the first one. Okay? And the real return, you just plug in the number. Nominal term, 7% for all three cases, and the inflation rate is different. Okay, got the real rate of return. So as the inflation rate increases, your real return basically decreases. Okay. Next one, 30. Now we consider the interest rate risk. Okay. Consider we have two bonds. A 3-year bond paying annual coupon of 5% and 10-year bond also paying an annual coupon of 5%. Two bonds, exactly the same. 5-year coupon, a 5% coupon, but with different maturity. One is 3, the other is 10 years. Okay, and both currently have face value. So prices are also the same. Okay, both currently sell at the face value. Now suppose that the interest rate rises to 10%. What will be the new price for the 3-year bond? What will be the new price for the 10-year bond? And we compare the percentage changes of the price for the two bonds. Okay. For the first bond, number of years to maturity, 3 years, and IY is 10, right? It becomes 10%. Okay, the yield to maturity, and PMT is a 5% coupon rate, 5%, and the future value 1,000. So present value is a negative of 875.66. Okay. What about a 10-year bond? Now 10 years to maturity. All the other variables are the same. We got the new price about $700. Okay. So we have two bonds. At the very beginning, they are all sold at the same prices, $1,000. And now the yield to maturity increases. And what we know is the price of the bond should drop. But we don't know which one should be dropping more. Okay. And what we see is the bond with the longer years to maturity, longer time to maturity, its price drops more. It's more affected by the interest rate changes. In other words, longer, so every other thing the same, the bond with the longer years to maturity are more sensitive to interest rate risk. Okay? Oh, all right, that's basically the answer to C. Okay, do you conclude that long-term or short-term bonds are more sensitive to a change in interest rates? Okay, long term, right? And intuitively, why is that? Because cash flows are farther into the future. It needs to be discounted by more times to a present value. Therefore, it is more affected by interest rate changes. Okay, think about a cash flow that gonna happen in tomorrow and 10 years later. Which one is affected more by interest changes? It must be the one 10 years later, right? Okay, so that is our first case. Now, second case. Two bonds. Now, interest rate changes. It increases from 8% to 9%. So which bond will suffer the greater percentage decline in price? A 30-year bond paying annual coupons of 8%, a 30-year zero coupon. Okay, two bonds with the same years to maturity. But difference is the coupon rate. One is 8% coupon rate. The other is 0% coupon rate. Okay, which one is more sensitive to the interest rate change? Yeah, well, I heard some answers. Let's take a look. So coupon bond, zero coupon bond. Initial price, 30 years to maturity. It's a change from 8 to 9. So 8% IY, $8 PMT, and 1,000 future value. Okay, because the coupon rate is equal to the yield to maturity, we got the face value. The price is equal to 1,000. Now the new price, 9%. We know it's going to decrease a little bit to about $900. Okay, it decreases by 10%. Okay, the new price divided minus the initial price divided by initial price is percentage changes in the price. Okay, this is about 10%. What about zero coupon bond? We're going to follow the same approaches. So So initial price is 30 years maturity, IOY 8, but PMT is 0 because we don't have any coupon. So future value 1,000, then present value is only about $100. Okay, and the new price becomes 9% IOY. The price was 75, and if we calculate for the percentage change in price, 24%. It decreases by 24%. So we know when the IOY increases, the bond price would be decreasing. But it turns out that the bond with a lower coupon rate is more sensitive to interest rate changes. So we got two principles. First, from the question 30, so the bond with a longer years to maturity is more sensitive to the interest rate changes. And for this one, we got the bond with a lower coupon rate is more sensitive to the interest rate changes. Okay. Why is this, right? Yeah. Same intuition. So for the lower coupon rate bond, a larger fraction of cash flows happen later in the future. And for a higher coupon rate, right, you understand? So if for a higher coupon rate bond, a larger fraction of coupon or cash flows happen in the near future. So it's less affected by the interest rate changes. Okay? And we call this in finance, we call this duration. Okay? We call this duration. So other thing the same, a bond with a higher years to mature have a higher duration. We mean as it's affected more by the interest rate changes. And a bond has a lower coupon rate that has higher duration. Okay? All right. 32, a dividend yield. So BMM Industries pays a dividend. So now we come to chapter 7. Okay, stock valuation. We are going to talk about a lot about dividend. Okay, so BMM Industries pays a dividend $2 per quarter, and the dividend yield on this stock is reported at 4.8%. So what is formula for dividend yield? It is the same with current yield. Exactly the same, but they are used for different financial securities. Dividend yield is used for stock, and current yield is used for bond. But they have exactly the same formula. So annual, now it becomes dividend. For the current yield is coupon, right? And divided by stock price. And for the current yield is bond price. Okay, so annual dividend, how much is it? $8, right? So 2 is quarterly dividend payment, so we need to multiply by 4. So $8 in stock price, we don't know. But we know the dividend yield is 0.048. Okay, so we got the stock price. 8 divided by 0.048. Okay, all right, 33. Integrated potato chips just paid $1 per share dividend. Just paid $1 per share dividend, okay? And you expect the dividend to grow steadily at the rate of 4% per year. And what is expected dividend in each of the next 3 years? It's gonna steadily increase at a rate of 4% per year. And it just paid a dividend of $1 some time ago, okay? Now let's see. So what is the next dividend? Gonna be 4%, right? So that's the dividend for year 1. What about year 2?
1 times 1.08.
Square, right? 1 multiplied by 1 plus 4% squared, or we can just multiply by once more. Okay? This. Or the year 3, same thing, cube, right? So 1 plus 4% cube. 1. Multiply by that. Okay?
Wait, yeah, if we do D and E. Okay.
Yeah. 1 multiplied by 1.04 square and cube. Okay, these are the 3 dividends in the next 3 years. Now, for B, if the discount rate for the stock is 12%, at what price would the stock sell? We know this stock, the dividend of the stock, is going to increase at a steady rate of 4% per year. What do we call? We call the cash flow. It's a growth perpetuity. The cash flow that increases year by year at a constant rate. In this case, 4%. But what is the formula for growth perpetuity?
for the
CF1, the next cash flow, divided by discount rate minus the growth rate. Okay, so in this case, stock price at time 0 right now should be equal to our next dividend, next cash flow. In this case, next dividend. Dividend 1 at the end of year 1, next one. Okay, and R minus G. So next one, how much is it? 1.04. Okay, now next one. This one. Okay? Right? Yeah, next one. $1 just happened. The next one is going to grow by 4%, 1.04. And R is 0.12, right?
Oh, you're saying
0.12. Yeah, 0.12. And the growth rate, yeah, is 0.4. So 0.08. So 1.04 divided by 0.08 is should be the current stock price. 1.04 divided by 0.08. All right, $13. It is, I think it's a rounding number, but very close, like 12.99 something. I'm not sure. Yeah. Okay. Good. So, okay. B. At what price should the stock sell 1 year from now? Similar thing. We're going to calculate the price at t equal to 1. Okay, t equal to 1 year from now. What we do is we're standing at the end of year 1 now. We're going to look at the next dividend and do the same thing.
This isn't the same question.
Wasn't it 33 we were doing?
Oh, sorry. This one? All right, okay. Yeah, sorry. Yeah. 3 years from now. Yeah, 3 years from now. Same thing. We are standing at the end of year 3, and we're going to look at our next dividend and divide it by R minus G. Okay? Let's draw a timeline. It's becoming a little more complicated. Now this is 0 is right now, and year 1 at the end of year 2, at the end of year 3, at the end of year 4. 0 at the beginning of year 1. 1 is the beginning of year 2. It is also the end of year 1. Okay? So our cash flow is 1.0 for, yeah, and 16, right? And the next one is 1.1249. These are the next 3 cash flows. Okay, see what is expected stock price 3 years from now? We're standing right here. 3 years from 1 year from now, 2 years from now, 3 years from now. What is the stock price right here? Stock right here is the present value of all the future cash flows starting from year 4. Okay, starting from year 4, the present value, all these cash flows. And we know it's still a growth perpetuity. It's still growing at 4%, right? And we can also use that formula. The only thing we need to know is the cash flow, the next cash flow relative to T3 right here, which is this one. We need to know that. We can simply multiply that one by 1.04 to get the new one, right? So the dividend for t equal to 4 is equal to 1.1249 multiplied by 1.04. Let it increase by 4% once more.
Yeah, I was gonna
I see confusing faces, right? Yeah.
So I was gonna say, when it says 3 years from now, why wouldn't it be the third? Why are you assuming that it'd be the fourth cash flow?
Yeah. Why not we use this one, right?
Yeah.
See, we have $1 right here. When we are calculating for P0, do we add for that $1? We didn't look at the cash flow that happened at that point of time. We look at the next one because it's just paid. So right here, we also assume this one is just paid. It's irrelevant anymore. The current stock price is only dependent on the future cash flows. Okay?
So, it's off investors' expectations, basically, essentially, or
No.
it's just the future. Okay.
Just a future cash flow. Yeah.
So always when they put the question like this, it's assumed that the dividend is paid and then the price is being calculated.
Yeah. Like what happened in T0. That $1 has been paid, and then the stock price needs to be calculated.
Okay.
Yeah. Okay. Yeah. We usually assume this, right? It doesn't need to be said. If it is otherwise, it should be said in the question, right? Ask your professor during an exam if I'm not sure about this. If this dividend has been paid or not. Okay? Yeah. Okay. Good. So next dividend, this number, and we divide it by 0.08. So the next dividend is this number divided by 0.08. We got the stock price at the end of year 3. Okay, at the end of year 3. So 14.62. All right. If you buy the stock and plan to sell it 3 years from now, what are your expected cash flows in year 1, year 2, year 3? Yeah, I shouldn't erase that. Yeah, it's right here. Yeah. It's right here. So 1.04. So at the end of year 2, remember, right? 0 is this, what that is that, right? That. So why is it this? At the end of year 3, why is it this?
Because you're also
Go back to your question, right? It just to be paid. This is the coupon payment that's paid at t equal to 3. It has been paid, and then we calculate the stock price, which is that. 2 parts. One that's to be paid, and then stock price is that. And we actually sell the stock at the end of year 3, so we actually get that price. That's our cash flow in year 3. Okay, so we add them up. And get the total cash flow in t equal to 3. All right? Questions? Don't understand? Good? Yeah?
Actually, I can set up like, for example, like if I want to calculate the dividend on year 4, I can set up the recent value is going to be 1, and then payment is equal to 0, and then like interest is going to be 4.
N is how much?
And then it's going to be exactly the same with over there. It's going to become like,
N is 4.
Yeah.
N is 4. Yeah,
Yeah.
same thing.
Yeah.
Yeah.
And then we have future
Right.
values.
Just use a calculator. So if this is the 30, it's going to be very cumbersome, right? So if it's 30, it's going to be very cumbersome. You're going to use that. But if it's 3, you can just use simple calculator to do that. Yeah, good. All right, so next one. E, what is the present value of the stream of payments you found in part D? What is your present value of all these cash flows? We're going to use the CF function. This is complex cash flow. These are all the cash flows that happen in the future. And let's quickly do that. So
when you're using the calculator for the dividend, what exactly is the way that you do it? So payment equals dividend, and then discount rate is the IY, and is the period future value.
no, we actually don't do that.
You don't do it that way.
We don't do that way. No.
So
Yeah.
you can choose the PV as the price as the initial dividend that you have now.
Yep.
Okay.
And then you have the I by Y is going to be your 4%.
Yep.
Okay, and then you have N, which is whatever N is.
Yep.
If it's 4 years, then N is 4,
Yep.
and so on.
And then we got a future
And you
value, and
compute
we
that
divide by 0.08. It's going to be equal to the price. And then you got the dividend plus the price, and then you got the final for the year 3. That's you got a payment for it.
Right.
No one's asking questions.
Okay.
You should calculate.
Oh, sorry. So we got those cash flows, year 1, year 2, year 3. 3 different cash flows in 3 years, okay? And we calculate the CF. We first clear the memory, so CF second clear, okay? And then what is CF0? This cash flow at T0? None, right? 0, there's no cash flow, okay? We start from year 1, so 1.04. Enter, down. How many period? 1, okay? Enter down. And C02, 0.0816. Enter down 1 period, okay? Enter down. And year 3 is 15.7449. Enter and down, and again 1 period, and down, and click the MPV, and it requires the interest rate, which is 12% in this case. Okay, required rate of return is 12, and enter, and down, and calculate. It is 12.9977. What I said in question B is this is like a 12.99 something. Actually, these are the same number. It's exactly the same. Actually, exactly the same. What we can get from this question? The stock price is equal to the present value of all the future values of this stock. Okay? No matter when we sell it, so we sell it at the end of year 3. It's going to be the same, even though we're going to sell it 15 years from now, 30 years from now. We first need to calculate the price at that point of time and discount it back.
So this entire exercise is almost like a proof.
Yes, it's not a proof, but it's demonstrate. Yeah. Okay, the price of the stock is the present value of all future cash flows, including the selling price. But the selling price itself is also equal to the present value of all the future cash flows relative to that point of time. Okay, good. All right, which one? 34. How much time? We're over time. Sorry for keeping you here. But this is important, right? This is very important. This is going to be helpful to your final exam. Okay, and all these questions come from your after chapter questions. Okay, it is most relevant questions to your textbook. Okay, all right. 34. Preferred products has issued preferred. Now we talk about preferred stock. Okay, preferred stock with $8 annual dividend that will be paid perpetuity. And discount rate 12%, at what price would the preferred stock sell? What is a preferred stock? Preferred stock is a stock that pays constant dividend in perpetuity. Basically, what we call that? So it's annuity. It's a constant payment which goes into forever. Okay? So we call it annuity. And the formula for the price of annuity is very, very simple. So it's P0 divided by the cash flow for each period divided by the discount rate. Okay? So for annuity. So therefore, we got the answer for A.
For perpetuity.
Yeah, for perpetuity. Yeah. So A periodic payment divided by the discount rate, 12%, 66.67. B, what would the price would be a year from now? The same thing. The annual payment divided by the discount rate. Same thing. This price is going to be the same a year from now. 2 years from now, same. 3 years from now, the same, because that payment goes into forever. Okay? C, what are dividend yield, capital gains yield, and expected rate of return on the stock? What are the dividend yield? Annual dividend divided by stock price. And the annual dividend is $8, always $8. And the stock price is always 66.67, 12% dividend yield. And the capital gain yield, no matter how long we hold this stock, its price is gonna still be, will always be 66.67. The capital gain will always 0. Okay?
How do we really know? We're just assuming various factors.
Yes, exactly. This is an oversimplified example in a very, very simplified economy. So it's going to be, in reality, going to be very, very complicated, but in the purpose of questions and practices and exams, we make it really, really simple like this. Okay? Yeah. Capital gain 0. Okay? And expected rate of return, we add them up. Why do we add them up? We actually know that because the holding period return, which is also we call that expected rate of return, the total return of during your whole holding period, is equal to current income plus the capital gain divided by the purchase price. And we split it up. Current income divided by purchase price plus the capital gain divided by the purchase price. They are the same, right? they are the same. The same denominator and the numerator add them up. Okay? And we call the first part dividend yield. And we call the second part capital gain yield. Okay? Dividend yield 12%, capital gain yield 0%. So the total expected rate of return is 12%. What I said is in the bond chapter is this also applies to stock, and what we see it actually applies. Okay? All right. The 35. Constant growth model. So Eastern Electric currently pays a dividend of $1.64 per share and sells for $27 a share. And if the investor believes the growth rate of dividend is 3% per year, what rate of return do they expect to earn on the stock? P is equal to the next dividend, 1.64. Currently pays a dividend. It seems like we need to multiply it by. So this is current one. What about the next one? It increase by 1.03. Okay, and what rate of return do they expect? We don't know R. Minus G is 0.03, and the P is how much? 27. Okay, good. R is only unknown variable. We calculate for R. See 1.064 multiplied by 1.03 and divided by this is transform a little bit, right? Solve for R, 9%. B, if investor required rate of return is 10%, what must be the growth rate? So the only unknown variable is growth rate. It is G, and all the other things we already know. Solve for G. Okay, it requires a little math. Do it slowly and carefully in an exam. Don't make a mistake on this part. Okay, I'm not going to show you how to derive that, but this is math. Okay? Okay, good. So C, if the sustainable growth rate is 5% and the plowback, what is plowback ratio?
How much you're investing back into the company itself.
And it is equal to 1 minus what?
1 minus the dividend
Payout ratio, right? Plowback ratio is the fraction of earning in that year that is reinvested into your business. It is equal to 1 minus payout ratio. The payout ratio is the fraction of income or earning that you pay to your stockholders. Okay? All right. And we know this formula, right? The growth rate, the sustainable growth rate is equal to ROE multiplied by plowback ratio. Okay? So what do we know? We know the growth rate is 5%, plowback ratio is 0.4. And what is ROE? Okay? ROE is G divided by plowback ratio. Okay? 12.5%. Good? Here are data on two stocks, both of which have discount rate of 15%. Stock A, stock B. ROE, earning per share, EPS, and dividend per share. Okay? So what are the dividend payout ratio for each firm? The fraction of earning that is paid out as dividend to investors. So total earning is $2 per share, and the dividend per share is $1, 50%. And the total earning for each share is $1.5, and dividend per share is like 67%. Yeah, 60. Yeah, good, good, good. So payout ratio 0.5, 0.67. And what are the expected dividend growth rate for each stock? G, right? That's for G. And ROE multiplied by plowback ratio. Okay. So plowback ratio is how much? Is this, right? It's 1 minus this. 1 minus 0.5. And 1 minus 0.67. But what is ROE? A return on equity. Okay, 15 and 10. Okay, so 15 multiplied by 1 minus 0.5 is also 0.5 and 7.5%. And 1 minus 0.67, 3.3%. Okay, G. Okay, next one, price. What is the value of each stock? Okay, how do we know this firm is growing? The dividend is going to grow because we reinvest. Okay, we reinvest so that our future cash flow will be growing. Okay. Otherwise, we won't reinvest. We just hold it. Okay. If we know that our future price, well, future cash flow wouldn't be increased by our reinvestment, why do we do that? Okay. And now we know there is a growth. Okay. It is growing. So that's why we use this constant growth model. It's just growing at a constant rate. And so the next dividend is $1. This is not very accurate. This is very blurry. So $1. We don't know if it is current one or next one. So just for demonstration, I show you this is 1. It could also be 1 multiplied by 7.5%. It's possible, and there's no correct answer in here. What I want to show you is how to calculate these 3 different things, and why do we use this constant growth model. Okay, so if I tell you that $1 is our next dividend payment, it could be simple enough. It would be just these 2 cases. Okay, if I tell you these are the most recent dividend payment, we're going to multiply by 1 plus growth rate. Good. 37. The constant growth model and the FinCorp will pay a year-end dividend $2.4 per share. Which is expected to grow at a 4% rate for indefinite time, discount rate 12%. So price would be okay. So we'll pay a year-end dividend. So that's the next dividend, 2.4, and divided by the discount rate, 12% minus 4% growth rate, $30. B is a little harder. So if earnings are 3.1 per share, what is the implied value of the firm's growth opportunities? Have you learned this?
Yeah.
Okay, some of you yes, some no. So stock price consists of 2 parts. A stock price consists of 2, but one comes from the future cash flow that assumes there's no reinvestment. Okay, all the earnings are paid back to the investors. But we know there is dividend, and there is a pullback ratio. Some earnings are reinvested into the business. And we know tomorrow, next year, the firm is going to grow and provide you higher cash flow. And we call those the present value of those increase the future cash flow, the growth opportunities. The fraction of stock prices that comes from the growth opportunities in the future, okay, we call that the implied value of firm's growth opportunities. Let me show you how it is calculated. So first, we got stock price, $30. We know it's 2 parts. One from the value that we assume there's no growth. So the other part would be the value of growth. Okay? What is the value of the first one? We can calculate for the first one. EPS divided by R. What do we assume in here? The earnings in each year are paid as a dividend to investors 100%. All the earnings in that year are paid to the investors. So we don't reinvest anymore. We don't reinvest, no growth. Okay? So what would be the value of the level of perpetuity into the future of, an amount of EPS for each year? Is annuity. Okay, perpetuity. EPS divided by R. $25. Okay, no growth at all. But we do know that there is a growth rate. Okay, there is a growth rate, 4%. And the present value of that growth opportunity in the future is just $30 minus the no growth stock price. And that extra $4 is the present value of the future growth opportunity. Okay? I believe your professors got more time to explain this to you on class, so I just go over it briefly. Okay? I don't have enough time. Okay. We are way over time. All right. Number 38. Startup industry is a new firm that has raised $200 million by selling shares of stock. And the management plans to earn 24% rate of return on equity, which is more than 15% rate of return available on comparable risk investments. Half of earnings will be reinvested in the firm. Half of earnings will be reinvested in the firm, so the plowback ratio is 50%. The payout ratio is also 50%. Okay? What will be the startup ratio of market value to book value? Okay. This is a long story.
Yeah, that's what I was going to say. What is the formula for that?
That's a long story. We know every formula that's going to be used in this one. We just need to combine them. Okay? Let me first show you the answers, and then let's backward deducting that. So we need to know the book to market to book value, market to book ratio, right? So first we know what is the market value, what is the book value. So the book value is the actual amount of money that you raise from your investors, okay? 200 million. That's your book value. That's actually the fund that you actually raised, 200 million, okay? But we don't know the market value. Market value is total stock price, okay? Stock price multiplied by the number of stock outstanding. But let's assume this is just one share in this firm. So stock price is a firm market value. So what do we know about the market value? We know, okay, it's just, there is 24% rate of return, okay, on equity, return on equity, and we know the required rate of return is 15%, and we know there's reinvestment. Since there's reinvestment and the ROE is higher than the required rate of return, we know that the firm is going to grow. And we can use the constant growth model. Okay? All right. But for the constant growth model, we need to know the growth rate. Okay? For the growth rate, we need to know the ROE and plotback ratio, but we already know this. We know ROE, 24%. And we know the plotback ratio, 15%. So we know G. It's 24% multiplied by 15%, 12%. So G is 12%. Okay. So the market value is equal to the next dividend. What is next dividend? Total earning multiplied by payout ratio. What is the total earning? 200 million investment multiplied by ROE, return on equity. You invest 200 million, and the return is 24%. The actual earning is 48 million. And for that 48 million, the payout ratio is 50%. So the dividend is 24 million. Your next dividend would be 24 million divided by 3%. So the stock price should be 800 million. So in this whole process, we basically know all the formulas. Now in this single question, we combine them up. So we know the book value, 200 million, and earning would be the amount of equity multiplied by return on equity, 48 million. And the dividend would be the ROE, the total earning multiplied by the payout ratio, 24 million. And use those numbers, we can get the growth rate, 12%. And then we can get the market value, stock price, okay, 800 million. And divided by book value, 200 million, is 4. Okay? So you're going to need some more time to digest this. Yeah.
The market value, so I'm just trying to understand. So that 24 million, that is the dividends. It's being... so, right, that's because stock price is the market value, but times... So what's the difference between the stock price and the market value? I don't understand.
In this case, we assume this is just one share. Oh. If a firm only have one share, that stock price just to be the market value of the firm, right? This is a very simplified case. Yeah.
You don't have to simply stock price multiplied by shares outstanding.
Yeah.
And in this question, it doesn't matter what the shares outstanding are actually. You're going to get these numbers anyway, because shares outstanding are going to cancel themselves out. When you do market to book ratio, the shares outstanding on the top, the shares outstanding on the bottom, they're just going to cancel themselves out.
Okay, so number of shares outstanding doesn't matter. Okay, doesn't matter.
So it's basically market cap over book value.
Yes, market value over book value. Market cap. Okay. Oh, B is, for question B, we changed a little bit. The ROE is now 24%. It's now 10%. 10% is lower than the required rate of return of 15% from the firm. And then let's look at the book to market to book ratio. Follow all the same procedures. In the very end, our market value is 100 million. And market to book is 0.5. What does it mean? It means we invest 200 million in the firm, and we only get 100 million in the future. Okay, so market value is lower than book value. This is not good investment. Okay, so in this case, actually, this is a loss, right? If we know this at the very beginning, we're not gonna invest in it. Yes.
Is that a common only? Because for Amazon, they usually pay a little bit dividend. I mean, too low, so that's why the market value usually lower than the book value they have.
Oh, really? So for Amazon?
Yeah, for Amazon.
Amazon, I think that's...
Yeah, because like in the past, they got a growth strategy, which also means they don't pay any dividend. Instead of that, they're gonna expand their business, so that's why.
I think Amazon is the only stock in the whole history that has a market value so high and has a loss for so long period of time. Right? This it's an amazing stock.
Number 39.
Yeah, something right. Yeah. Okay, so 39. You expect a share of a stock to pay dividends of $1, 1.25, and 1.50 in each of the next 3 years. You believe the stock will sell for $20 at the end of the third year. What is the stock price if the discount rate of the stock is 10%? Discount cash flow. And it is a complex cash flow. Okay? 0, 1, 2, 3. So the next dividend in here is $1. And here is 1.25, and here is 1.50. And we know the stock will be sold for $20 at the end of the third year. We plus it by $20. Okay? And use a 10% discount rate. We discount it back. And you just use complex cash flow procedures. We're going to get the stock price. Okay? And the mathematical formula is this. So 3 cash flows for each of the 3 years we discounted by the 1 plus the discount rate, and squared and cube, okay, and get the stock price. And what is dividend yield for year 1? Dividend yield for year 1, the dividend we got in year 1 divided by the stock price at the beginning of year 1. So okay, $1 divided by stock price, okay, stock price, okay, dividend yield. And what will be the dividend yield at the start of year 2? At the start of year 2, so it's just right. Where is it? Right here. Okay, as this is start of year 2, it's gonna be the dividend they're gonna receive in year 2 divided by the stock price at the beginning of year 2. At the beginning of year 2, what will be the stock price? The present value of all the future cash flow, basically these 2 cash flows. Discounted these 2 cash flows back. Okay, we get the stock price at the beginning of year 2. And divide the dividend year 2 divided by the stock price in year 2, beginning of year 2. Okay. All right. Number 40. A company will pay a $2 per share dividend in year 1, and the dividend in year 2 will be $4 per share, and they expect to grow at 5% per year thereafter. Okay. And the expected rate of return of the stock is 12%. What is the current price of the stock? 1.23, okay? We'll pay a $2 dividend in here, okay? And the dividend year 2 will be $4. And starting from year 2, it's going to increase at a rate of 5% forever, okay? And what is the current stock price of the stock? So we know that it starts from here, it's going to increase at a constant rate of 5% forever. Therefore, we can get the stock price right here for all those, the present value of all those cash flows, and plus it by 2, discounted back by 1 period. And again, there are multiple methods to do this. This is not the only one.
Don't we need to discount that first period back, and then we also discount like separately? So we discount
exactly. We can also do that. Depends. It depends on what your professor taught you and what method you are more comfortable with.
Which is the quickest way? What do you say?
I would say this one is for quickest way for me, but not necessary for you. Okay? But the only thing is you know what you are doing. Now but what he does is he separates the cash flow into 2 parts and calculate for the present value separately and in the very end add them up. But what I do is get the present value of those cash flows at this point of time, add them up, and discount it back by 1 period. Different procedure, but you'll get the same number. So let's use my method first, okay? All right. What would be the stock price at P1? It's going to be the next dividend, which is $4, divided by expected rate of return 12% minus growth rate 5%, which is how much? 57.5. 143. Okay? But this is at the t equal to 1. So the other cash flow is 2. 2 plus 57 and divided by 1 period and discounted by 1 period. Get that? What he does is, we have a 2 in here, we have a growth perpetuity in here. We can get the present value of that $2 by discounted by 1 period and get the present value of all those things at t equal to 1 discounted by 1 period. Okay, if I understand correctly, but they are all correct.
Better,
Yeah,
That's
yeah.
what the professor taught in my class.
Yeah. Okay. Sure, yeah. So what is the expected per stock price in a year? Actually, that's what we just did. Okay. P1 is the expected stock price in a year. And C show that the expected return 12% equals dividend yield plus capital appreciation. We calculate separately. I already showed this. Dividend yield is dividend divided by the stock price at the beginning of the period. And the capital gain yield is the ending price minus beginning price divided by beginning price. Add them up, we see it is exactly equal to the required rate of return, 12%. Okay, 12% has 2 parts, current part and capital gain part. Okay, all right, this is the last question. Okay, this is the last question. And it's a long one. Better Mousetraps has come out with an improved product, and the world is beating it a path to a store. Okay. As a result, the firm projects growth of 20% per year for 4 years, and by then, other firms will have a copycat technology, and competition will drive down the profit margins, and the sustainable growth rate will fall to 5%, 20% for 4 years, and then 5% for forever. Okay, and the most recent annual dividend is $1 per share. And what the expected value is the dividend for each of the next 4 years? We just paid $1, increased by 20%, increased 20% squared, 20% cubed, 20% to power 4. Okay, the dividend in each of the next 4 years. And what is his expected stock price 4 years from now? We need to know the dividend in year 5. Okay, that's the next dividend relative to year 4, right? Year 5 divided by R minus G. Okay, and we know at the end of year 4 it is $2, and we increase by 1 more period and divided by R minus G.
Would you be able to go back just to see the question?
Yeah. So what is the stock price today? Complex cash flow. Okay, complex cash flow. I'm not going to do it. Just to follow the methods we just talked about. Okay, and dividend yield same. Dividend yield we got those numbers right. Dividend 1 and P0 is from question C. Next year stock price same thing, right? So dividend complex cash flow. And what is expected rate of return to an investor who buys the stock now and sell it a year later? Okay, 2 parts, the dividend part and the capital gain part. And the capital gain is the changes in price. Okay, all right, guys.